Just a coincidence that Mahesh Patil also represents AB Capital. AB Capital is the holding company of Aditya Birla Sun Life Mutual Fund, which is what he's associated with, and Kunal is bullish on AB Capital as a stock. Don't worry, you can smile. I'll not ask you your opinion on the stock. I know compliance is there.
Very good.
How are things? Hi Mahesh, how are things?
Yeah, fine, Niku. Yeah, good morning.
Markets have done rather well for themselves, even though earnings have been just about sober. Flows, macros, they've really supported the market quite a bit in last 2 or 3 weeks. Do you think there is more tank left in the fuel?
Yeah, I think the worst, I think in terms of the concerns which we had, right? Both in terms of one, initially it started off with the slowdown, okay, our domestic growth slowing down, earning downgrades, okay, which happened last year. We saw a significant downgrade to earnings, right? Almost like 12% or so for FY20, 25. I think that is clearly behind us. I think this last quarter numbers, okay, which came in, are we've not seen any meaningful downgrades after that for FY26 and FY27 numbers, and I think we are looking at this year a reasonable growth, okay, clawing back to around our long-term trend growth of around 12 to 13%, which looks plausible. I don't see much risk to that because a lot of the sectors, okay, which kind of underperformed last year, we are seeing some signs of recovery over there. So that's one. On the global front, also, I think the risks which were there because of the tariffs, US tariffs, which was there, that is also kind of now waiting. And I think the one sentiment itself, we look at, right, which is the mood of the market, reflected in the fact that the breadth of the market, which was kind of very weak, we see that is also starting to improve now with the mid cap and small caps also now participating. Retail participation is starting to now come back to the market. So I think given all these factors, also the most important thing is the policy environment, right? We have the monetary policy now tomorrow, and it's been fairly supportive for growth. We've seen 2 rate cuts already. We're expecting another 2 rate cuts or even 3 rate cuts in this cycle. And more importantly, the overall system liquidity is now in positive territory, and we'll have a more durable liquidity around. So I think all these factors at least takes the fact that the negatives or the fear of the market going down, I think that's behind. Now it's really going to be in terms of how the earnings pan out from here on, because market is at a level now which is kind of pricing both the negatives and positives also. So there's not any scope for, at least one should not expect any scope for re-rating from these levels. So I would say it will have a more now sedate journey from here.
Let's look at the other contra view, Mahesh. There are no triggers, and we are perhaps at the peak of good news. When you are at peak of good news, some would say that markets also are priced to perfection. Like we always say that good news and good prices that rarely comes together. Right now there is good news, but our price is good.
So that's, I mean, most of the time, if you look at the markets, always look priced to perfection. Only very few instances, okay, where we see is like undervalued in crisis or probably overvalued. I think more importantly is that whether market growth, earnings growth of companies, okay, we track that growth or whether there are downgrades to that. So assuming that there are no downgrades to earnings further from these levels, then I think the earnings growth to say the market is fairly valued, then you'll roll forward 1 year, right, next year. And that's the kind of a return I think one can expect from the market. Obviously, again, on the flow side, because in the shorter term, the flows would drive the market. So there also we've seen that despite all the volatility, what we saw and the concern and the sentiment was negative, okay, last 6-9 months period. I think the flows into the mutual funds and this thing have been fairly resilient. Okay, we see that steady wall of money which is coming in. So that should support. So I think it will be a kind of a slow climb from here. They could be, as I said, there could be negative news on the global fund market could react, but at least the move looks like it will bounce back from those levels and try to create now higher tops.
Mahesh, morning. This is Shrishti joining in. Help us with your latest take on the banking in the financial space, because Mahesh, the last time you connected with us, you seem to like this space, especially banking, on the back of deposit growth improvement that you were anticipating, and you also believe that the rate cut should aid NBFCs. Now that we are looking forward to another rate cut happening tomorrow, give us some sense that what's your latest take on this space, and given the run up as well, has anything changed for you?
Yeah, I think the banking sector has done well in the last say 3 months or 6 months period. So now I think it's no longer in a territory where you can say it's undervalued. Okay, valuations are now more reasonable in compared to the long term average, and I think while the more rate cuts happening will be in the short term negative for the banks, especially the banks, and this year actually would be a period where you will see only a high single digit kind of a bottom line growth for the banking sector as a whole. So that's not really going to really drive the stock re-rating from here. The only positive for the banks would be that the easy liquidity conditions, okay, whether that would lead to the pressure on deposit, which was there, I think that is easing. We've seen now banks starting to cut deposit rates. So I think to that extent, I think they should be able to some extent manage the margins. But I think the real trigger for the banks now here will be the credit growth, because now it's no longer the supply side constraint which is there, right? From the deposit side, I think that's not a challenge. It's on the demand side, because the overall credit growth is still not really strong. Okay, what one would expect. Corporate credit growth is still fairly weak. We've been expecting a recovery over there, but corporates are still in a deleveraging cycle, and with the uncertainty global, we've seen not really coming in and doing large capex. So that continues to remain weak, and hopefully that should pick up going forward. On the retail side, also the growth has been better than definitely this thing, but still not really caught up to that extent. So I think if the credit growth picks up, okay, in the say mid-teens, so then I think there's further scope for the banks to do well. NBFCs, yeah, probably would still be better off, because there I think the rate cut cycle would act in their favor. And I think some of the tier two NBFCs are where the valuation comfort is still there. We've seen a re-rating of the top tier NBFCs, but the tier two NBFCs, especially some of those which have gone through a kind of a credit cycle within MFI space, I think those are turnaround candidates, okay, which can potentially re-rate from here.
Mahesh, let's look at some beaten down pockets. One is NBFC, other is IT. At what point in time IT will start looking attractive? Dividend yields are looking attractive for, let's say, stock like HCL Tech. These companies are sitting on a lot of cash. The return ratios are not that bad. Everyone's written them out because of AI. Is IT looking more like a value buy now, more like a contra buy, where you buy now, be patient, 2 years you'll be rewarded?
I think seriously, IT, the one thing is clear that the overall growth there is not likely to be very strong, while downside also is limited, because we are not seeing, I think, the worst fears of a US recession, okay, which I think they are now abating. So I think at least we are not building that in our base case. So given that, I think the risk to IT on the downside, I think, is limited. But I think the overall growth, okay, is going to be in the kind of a mid-single digits, which is not very exciting. So I think it's kind of a trade-off, right? So if the domestic market or the domestic economy does well, a lot of sectors and domestic facing do well. For example, if the banking sector, the credit growth picks up, then the relative outlook for some of the sectors will look better, and then money flow would move into the sectors. But if the outlook on the domestic side continues to remain slightly weaker, then I think IT, with its kind of a mid-single digit growth, okay, and to some extent the higher dividend yield, which is there around 4% or 3 to 5%, which you see the larger companies, then it offers a good risk reward, okay, for someone to play that. So it would boil down to how the other sectors does for the money to move into the IT sector. On an absolute basis, I don't see much of a downside over there. And yeah, it can be a contrarian, but it is going to be a relative rate how the other sectors do well. If you see growth picking up in other sectors like consumer, for example, which has been weak, I think then, because that is another sector besides IT, banking, consumer, another sector which normally people compare with the IT sector because of the large free cash flows, right? High dividend yield, which is there, and also relatively sedate growth. So then these are the trade-offs I think we should have to see for the IT sector to really do well from here. We are currently kind of a neutral on that sector.
Mahesh, I once again want to draw your attention back to the expected interest rate cut, though you believe that further rate cuts can be a little negative for the banking space in the short term, but this is generally seen to be a positive move for the discretionary spending. Within that, the auto turns favorable, the sector outlook, along with that the real estate sometimes get a push. But this time, do you believe this particular thesis will hold true? Are the valuations comfortable for the stocks to take them up?
So, yeah, I think you're talking about the other sectors besides the banking.
Yes, and their
Okay.
expected impact
Yeah.
because of rate
Yeah.
cut.
So, has been weak. Okay. There are two parts to it. One is the urban and the rural. So, urban is more dependent on, to some extent, also on interest rates, because a lot of urban consumers have got mortgages, and with interest rates coming down, that should support over there. So I think, yeah, clearly, I think urban consumption, I think, can see an up move if we see more rate cuts over there, whether it is the mortgage sector, whether it is the auto sector. But I think the rural economy is also very important, and I think there are some tailwinds. Okay, what we are seeing on the consumption side, because the inflation has been kind of trending down, so the real wages are now looking much better over there. Monsoons have been good. I think this year, I think the crop output is supposed to be fairly good. So I think all these factors would one would expect the rural incomes to be better this fiscal year, and that could drive rural good growth. I think we are seeing that also commentary from a few companies coming in that direction. So given that, I think the outlook on some of these sectors you talked about, whether it is the auto sector, currently the outlook is still weak, right? We are not seeing any kind of pickup, but I think one can really hope that in the second half after the festive season, I think there could be a pickup over there. Valuations in some of the sectors are not necessarily cheap, but they are reasonable. I think we have seen this some of the stocks in this sector underperform. So I think there is nothing really cheap into the valuations, but reasonable valuations. More about the delta change. If we see the trend changing, I think then these sectors can start to. You could see again upgrades in the earnings cycle, and this sector can start to outperform. But I think I would be more constructive on some of those sectors related to the rural economy than on the urban consumption.
Mahesh, the grain of the truth here is that small and mid cap stocks have rich valuations, and there is no second view about it. Yet small and mid cap stocks, they tend to outperform. Yet small and mid cap stocks, they continue to get inflows. Where is this entire cahoot of small and mid cap, or this entire clan headed?
So I think it's more to do also with what we had seen was in the post-COVID, the growth. It's all a function. The earnings growth on the mid-cap and small-cap companies was much higher than the large cap or the broader market, you would say. And that was one of the factors. Obviously, we had seen a lot of money coming into the sector, and we saw re-rating of that sector also. So it's a combination of higher earnings growth and P multiple expansion, okay, which led to the kind of outsized returns in the small and mid cap sector. In the last 9 months, we've seen that earnings growth has kind of converged a bit, okay, for the mid caps, especially if you look at it compared to the large caps, it's more or less in line. And valuations are also corrected to some extent, but they're still expensive, I would say, especially in the mid cap space, I would say. Now the question is whether the growth in this mid cap and small cap sectors, at least outlook over there, is better than the large caps. I think post the reset, what we saw in this year, at least on a bottom up basis, we are seeing in our universe, the mid cap and small cap, the earnings growth is slightly better than the large cap companies. So if that is the case, then I think while the valuations are still higher, I think they can, if they are able to exhibit a better growth, then one can see this kind of people moving away from mid and small caps. I think money will start to again come back into the sector, and we've seen that early trends of that happening. So I would say that while the risk reward, we still at this moment believe that it is better in the large caps stock, because obviously in a market correction, any kind of a risk off globally, it will provide you that downside. But I think if we have a 3-year, 5-year view, I think mid cap and small cap bottom ups will continue possibly still in Indian market where the growth outlook is better on the domestic side. I think you would see them outperforming.
So Mahesh, where is the next big earning dhamal, as we always use on Dalal Street? where is that big sector where earnings are going to go gangbusters? We are in for a big earnings surprise from next 2 to 3 years standpoint.
So very difficult to say, I think, at this point in time, if where the bigger. But I think one can have a different approach, right, in terms of trying to see which are the sectors which are where they have underperformed, or I mean, earnings are disappointed, right, for various reasons. Because where there is disappointment, I think there is a chance for a surprise or improvement over there. So if you look at sectors like, for example, one is classic is the chemical sector, right, which has gone through a pain period for the last 2 years. We've seen earnings downgrade. I think we have seen signs of recovery over there. The whole inventory build-up, which was that has got corrected. The agrochemical sector globally is now starting to look better, even domestically. And I think with the trade wars, I think tariffs, I think we've seen some kind of a benefit possibly playing out to that sector. I think so. That's a sector where I think you could see, and there's a lot of capacity which has already been invested in the last 2 years, right? It's now time to get the benefit of that. So I think that's a sector I think which can potentially see a surprise both in terms of top line as well as earnings margin improvement over there. Second is the consumer sector itself, right? Again, I talked about it earlier, right? It's gone through a pain period, very, very kind of a feeble growth. There were other factors also which were impacting. There was a impact on margins because of input in the commodity prices, especially the palm oil prices. We've seen that kind of correcting now. And with recovery, if at all, which happens, that can give an operating leverage over there. So I think that's another sector which can potentially surprise positively, where the expectations are very low. And so I think that counter-cyclical approach, I think, will be really worthwhile here, because we're not seeing any big momentum in any particular sector which could surprise. Another sector is like defense, right? Because of the recent kind of what we saw, right? The skirmish between India and Pakistan. Clearly, there is a view that defense spend as a percentage of GDP needs to go up from 1.7 to around 2.5%. There is a short emergency procurement program which is underway. So that could lead to some orders flow through in the next 1 or 2 quarters for some of the companies. And you could see that surprise in terms of order inflow and earnings coming into that space.
Right, but Mahesh, just wanted to have your take on the cement pack as well, because that particular sector I see that is on your overweight list for most of your funds that you hold. And give us some sense that what do you see actually changing for the sector? Because yes, of course, some months we do hear the prices going up, but now that the price hikes are taken back. But there are a lot of regional players involved, and along with that, from a consolidation phase, the companies are now focusing on expansion. Give us some sense that why do you believe that this sector can do well, and what's really changing?
So our view on the cement sector, while there's nothing, as I said, immediate triggers which are there, we're not seeing any meaningful pickup in the volumes in that sector. It's coming up from a lower base of last year. But if you look at the overall cement sector, it's at the bottom of the cycle in terms of the EBITDA per ton. Last year, if you look at the EBITDA per for the cement sector was kind of the cyclical bottom. So again, taking a more contrarian approach in terms of that some mean reversion will happen. And we are seeing that at least on the raw material side, the cost side, with oil prices coming down, fuel costs kind of edging lower. I think that should help. The key question is about the volume growth, which is still not very strong. But I think we could see some pickup for that on the rural housing front going forward. So it is more of a contrarian approach. There's nothing really immediate to suggest that you could see a very strong earnings uplift. Obviously, compared to last year, the EBITDA per ton trajectory is likely to improve. And that's the reason why I've been overweight. Not too much, but I think the real outperformance will come in only when the volume growth starts to move somewhere in the 6, 7 or high single digits, which is still kind of awaited. So I think in that scenario, I think the large cap cements are now fairly priced, I would say, right? From a valuation standpoint, is the mid cap cement companies, okay, where there is some potential for re-rating. I think where they could be, if the outlook improves, I think you could see a better performance over there.
Really appreciate your time, and glad you could join us. By the way, Mahesh, summer holiday done for this year or still going for it?
Still going for it, yeah. Next week I'm planning.
And where are you going?
Thank you.